In this video, I'm going to talk about QBI, Qualified Business Income Deduction. This is coming with the Tax Cuts and the Job Act in 2017, Section 199A. So it is a very, very complicated subject. So I'm going to try my best to explain it. I can go as much as the detail I can go, but it's a very complicated subject. So Section 199A deduction. So if anything you want to remember from this video, just remember why you want to do it as a business, why you want a QBI. So because you deduct your 20% your qualified business income, so you do not pay tax on this 20% of the QBI. Let's say if your business you make $200,000, right? So you can you can deduct 20% of it, which is $40,000. So you do not pay tax on the $40,000, which is a lot. However, it's not everybody is eligible for. Who is eligible, and there's complicated, the taxable income phasing out, and have different business qualification here. So that's why I'm talking about it. First of all, let's read this. Many owners of the sole proprietorship, partners, S corporation, and some trust is that may be eligible for qualified business income deduction, also called Section 199A, for the tax year beginning after December 31st, 2019. First here is for nearly all the business entities except the C corporation. So basically it's something for, because C corporation in the Tax Cut Job Act, they get reduced tax rate to 21%. So everybody else is still in a high tax bracket, just pass through entity, right? So that's why Congress created this QBI 20% deduction. So that's why something you should know. The deduction allows eligible taxpayers to deduct up to 20% their qualified business income, plus 20% of the qualified real estate investment, dividend, and qualified public trade income. So income earned from C corporation or by providing service as an employee is not eligible for the deduction. The deduction is limited to lesser the qualified QBI components plus the REIT PTP components, or 20% of the taxable income minus net capital gain. So we're going to talk about detail in those things. So determine your QBI. So what is QBI, qualified business income? Basically say qualified business income includes qualified items of the incomes gain, deduction, losses from your trade or business that are effectively connected with the conduct of business in the United States. This income qualified item from the partnerships, the S corporations, so proprietorship, certain estate and trust that are allowed calculating your taxable income for the year. So here, the deduction is available to all the taxpayer, which is passed through entity other than C corporation. So you can see QBI is the income. So basically, you have the schedule K, if you have a Schedule K, a Schedule C, so those income usually on those forms. Then detail will tell you that most investment income is not included as part of the QBI. So this thing you can see short long-term capital gains, any dividends paid to the dividends, any interest incomes, any other received annuities, those things are not part of the QBI. So in addition, QBI is reduced your self-employment tax deduction, self-employee health insurance deduction, and their contribution to the qualified owners, the retirement contribution. So this is basically what is in the QBI. So basically, if it's passed through, it's the same on your Schedule K and Schedule C. So those things. So do not include any other investment income. So QBI deduction, we already talked about it. Say your 2021 taxable income before your QBI deduction is less than. You can see this coming out with the phase-out range. So if it's less than 329,800, this is married file jointly, and if you are single, it's 164,925. So the amount of your QBI deduction is 20%. So if you don't have this REIT and PTP, so basically it's your 20% of the QBI, and this is lesser of, right? The deduction is limited to the lesser of this amount, 20% QBI, or 20% your taxable income, calculated before your taxable income calculated before the QBI deduction minus your net capital gain. So you can see here, QBI deduction. Okay, what do you get deduct from, right? Let's say, well, it's lesser. It's lesser 20% of your QBI. If you have raised PDP, you can add it to it. Then 20% taxable income before QBI minus the capital gain. So basically, you compare these two. Which one is lesser? If your taxable income minus capital gain is greater than QBI, so your deduction is 20% QBI. So you can see here, that's taxable income limit, right? If your taxable income is lesser, so most of the time is your 20% taxable income. Here on side QBI deduction, phase out range for taxable income before your QBI deduction, you can here give you the range. Basically, if you are less than 329,800, if you are married file jointly, so this is for QBI to determine if you get for 20% of the QBI. So you can see it's a 2-layer, right? This range is determine how much if you get for 20% of the QBI, right? And so if your range is above this, you know you are not eligible to get ABI to a QBI deduction. So basically is that. So another thing with the QBI we call specified service trade business. So this is called SSTB. SSTB is defined and below. So basically, say if you are SSTB type of business, once your taxable income exceeds the top phase-out range, there's no QBI deduction allowed. So basically, if you above this, if you married file jointly, if you are single, if you above those amount, so you you do not allow any QBI deduction, right? So what type business is SSTB? You can see SSTB is any trade or business involving the performance of the service in the health, law, accounting, actuary science, performing arts, consulting, athletics, financial service, brokerage service, and any trade or business where the principal assets such as trade business is reputable or skilled or one or more employees. So this is what is SSTB. Then any others is like investing, investment management, trading, or dealing with security. So you can see here those type are the SSTBs. Let's say if you are a CPA firm, right? CPA company. So your partnership, your income is distributed to each partners. So basically, if you're married file jointly, if your annual income is more than 429,800, so you are not eligible for QBI deduction. However, if you are below this 329,800, so you are qualified for 20% QBI deduction. Then be careful. You are allowed for 20% QBI deduction. However, this 20% also be restricted by 20% of your taxable income. So that's you have to see what you qualified there. So here give you a little diagram. Say is 20% QBI deductible, right? So we talk about the SSTB business. So SSTB business, if you are under this phasing out, your 20% QBI is deductible. Then if you are above it, there's no QBI deduction. Then if you are not service, you are not SSTB. So let's say we talk about engineer, architecture. So if you have your own business, you are now SSTB. So when you under the phasing out range, so your 20% QBI is deduction when you above it, and so there's a different way to calculate it. So that's you still eligible, but will be reduced amount. So deduction. Then here's a little example. This example is under threshold. Basically, is less than this amount. Married file jointly. Single is less than this amount. This example is a married couple filed jointly with taxable income $300,000. You can see this is under the threshold, right? So including the taxable income is $40,000 long-term capital gain. So you can see here, you have a taxable income, you have to deduct the capital gain, which is 260, become 260. So that is 20% of the 260. You're gonna compare that to your 20% QBI. Your QBI is $290,000. So you can see 20% of your QBI is $58,000. However, you have to look at another 20% of your taxable income minus capital gain is $52,000. So in this case, you are only allowed to deduct $52,000 rather than the 20% of the QBI, right? So that's the income 20% of taxable income limitation. Then we talk about non-SSTB. So when your taxable income is between the phase out range, right? if you between the phase out range, so if you are now SSTB, so 20% of the QBI, so you choose the lesser of this each. Then the second one, you have to choose the greater one. 50% taxpayer allocated of the W2 paid by the business, or 25% allocated of the W2 by the business. 2.5 taxpayer shares on just the basis of this. So, okay, this is a lot. Anyway, maybe you can just remember is 50% of the taxpayer allocated share W2. So if you are non-SSTB, the QBI deduction is limited by 20% taxpayers' taxable income reduced any capital gain included. So this is even, well, this basically is 3 criteria. First of all, you determine the QBI, right? QBI is the deductible among the QBI is 20% of the QBI or the this one. So you choose the lesser of it. Once you get the deduction of the QBI amount, you're gonna compare to 20% taxpayers' taxable income minus the capital gain. So if you see the less amount, so complicated. Let's see the example. So this one is assume Andy and Amy are married. Taxpayer filed jointly with taxable income $450,000. You can see this is $450,000 taxable income. Then have a long-term capital gain is $40,000. 450 minus 40,000, then you get the $410,000 if you times 20%, so it will give you $82,000. So that's the 20% taxable income. So if your QBI is deductible QBI is greater than that, you only can do the 20% of the taxable income. However, we have to figure out what is QBI deduction amount, right? So this is another thing. So he's so who is Annie is shareholder in an engineering firm. Engineering firm is now SSTB. So then you can see here. So he's a K1 from the S corporation showing here. So net income is $350,000. W2, which is $125,000. Then qualified property is $60,000. So you can do this 20% QBI is equal to $70,000. Then you do 50% of the $125,000. So you can get this. Then you do 25% of the W2, then 2.5 of the 60. So you will get the total amount $32,750. You compare to 62 and 500. So you get the greater, choose the greater one is 62,500. So then you compare 62,500 to the 70,000 and $70,000. So you choose the lesser one. The lesser is 62,500. This is your QBI deduction. This is your QBI deduction amount. So your QBI deduction amount you compare to the 20% of your taxable income, 82,000. So QBI deduction amount is lesser. So you're gonna deduct 62,500. Okay, so that's how the calculation. This is very complicated. So if you think that is complicated, then another thing is we only did side is between, right? The last example is between this phasing out range. However, if you over this phasing out range, this is a lot another layer of way to calculate it. So it's very complicated. You can find the information on the IRS website. I will show you the forms you're gonna looking for then to calculate this thing. Anyway, so let's do a little comparison about the SSTB and the non-SSTB. So SSTB, so if you under this amount, the phasing out, so you allow 20% QBI. So be careful, 20% of the taxable income there as well. So 20% QBI, then other 20% QBI. So if you between this is phasing in of the wage property limit. So basically, I just show you how phasing in the wage and the property limit of the wage. Okay, so I just show you how to calculate the, you have to compare the 20% QBIs and other wage stuff you need to do. So anyway, SSTB, if you above this, the upper ceiling of the phasing out, so you cannot deduct any QBI. For non-SSTB, you still can deduct, but you have to figure out the amount here. So it's a lot of fun. So basically, give you a little summary. Just to say, well, if you deduction available regardless whether the standard deduction or the Schedule A itemized deduction are taken. So basically tell you this is kind of on top of the standard deduction and the Schedule A itemized deduction. So 20% deduction for QBI is from passing through entity. So if you do the 20% QBI deduction, so basically if you are in a 37% of the marginal tax rate, this will reduce your marginal tax rate to 29.6%. So anyway, so if say for 2017, the Tax Cut Job Act has reduced the corporation's tax rate to 21%. So this is very beneficial to the business. So as here said maybe if you don't have this 20% QBI deduction, so then many businesses maybe convert their entity, from other pass-through entities to, C corporation. So that's why they have a 20% QBI deduction. So additional information. So basically, that's the form 8995. You can say qualified business income deduction. So there's many type of the 8995. So they have 8995 A, B, C, D, different forms. Just to make sure you know which one to use. So for more information, you can read the instruction of the form 8995A. So there's a different form as well. So anyway, that's just a little basic information regarding QBI.